Before heading to Davos for the World Economic Forum, Maria sat down with Saira Malik, Nuveen Chief Investment Officer and Head of Equities and Fixed Income. She got her take on Nuveen's capital allocation, Federal Reserve policy decisions this year, and the state of the American economy. Take a look.
Saira, great to have you. Thank you so much for being here.
Great to see you, Maria.
I want to start off with your thoughts on the macro story and sort of what you're looking at to guide you as far as how you're allocating capital here in this new year. How would you assess things, the backdrop?
Well, 2026 so far has been a tale of macro versus the micro. We've been dealing with three factors, and that's geopolitical issues, Fed tensions, and earnings growth. Where we're hanging our hat is on earnings growth. We expect earnings growth for this year to be over 10%. We're already seeing that with a strong fourth quarter 2025 earnings. And tech should lead earnings with 2 times the earnings growth of the rest of the S&P 500. So I think that tech continues to lead from here. We're going to see strong earnings from those companies. And that's what's going to lead the S&P higher this year. Our price target is 7,500.
Yeah, that certainly has been what it looks like. You've got strong earnings. You've got lots of things happening with the big, beautiful bill expected to have an impact as well. And then you've got all these other things that President Trump has been doing, whether it's the ban on large institutional investors purchasing single-family homes or the $200 billion of mortgage-backed securities he wants Fannie Mae and Freddie Mac to buy, $500 billion increase in defense spending in the big, beautiful bill. And, of course, the most recent is this cap on credit card interest rates. What are your thoughts on these agenda policies that could actually move markets?
I think 2 agenda policies to watch for this year are going to be around affordability and deregulation, and that is good for the American consumer. What we've seen in the past is a K-shaped consumer, where the higher-end consumer has continued to spend, but the lower-end consumer is struggling because of higher inflation. So anything that supports affordability should help stabilize the consumer. Deregulation is going to be good for the markets, especially for banks, and we've seen that already with bank earnings for the fourth quarter of 2025. Deregulation should help open up capital markets, make it easier for banks to operate. That's going to be positive for that earnings growth number that we're relying on this year.
What about valuations, Saira? Are you worried that valuations, particularly in the tech sector, are becoming overdone?
I'm worried about valuations overall. Admittedly, the market came into this year at a premium, and that always raises the risk for volatility. And that gets us back to my first 2 points around geopolitical issues and Fed tension. I think those would be the 2 issues that could cause volatility, which would hurt in a premium valued market. Our call is for 2 rate cuts in the back half of 2026, delivered by the new Fed chair, but also tensions around Fed independency do make the markets nervous. So those are where we'll get our bouts of volatility. Our expectations are we get 2 rate cuts, but they're in the second half of 2026. I don't expect a rate cut in the first quarter, probably not even in the second quarter. I think, we're down to a handful of candidates for the Fed chairman position. I think either one won't change our trajectory for rate cuts. What are those going to be driven by, though, beyond the new Fed chairperson? Inflation is not accelerating. It's plateauing, and I think it'll continue to decline as affordability measures come into play. So I think that'll cause more measured inflation going forward. But on the other side, employment markets, we view those as relatively stable still. Employment has declined, but we still are in a job creation environment. And so employment markets look okay to us. Consumer could do better. Inflation, reasonably benign. That opens the door to 2 rate cuts in the back half of 2026.
Well, it's interesting because we're talking about a good performance so far. I mean, some people are expecting 5% growth for GDP, and yet the early signs of the earnings within the banking sector were mixed. So what are your expectations in terms of which groups will actually show the best growth when you're looking over the year to come?
I follow the earnings data. The group that should grow the fastest earnings over 2x the S&P 500 is tech. So that's what we think will lead. Bank earnings, somewhat mixed, but banks had a strong rally last year versus the S&P 500. So a lot was priced into banking stocks. The story of deregulation, the optimism over capital markets business doing better, rate cuts, all of that positive for banks. And so it'd been somewhat priced in. And then, of course, the credit card cap did make investors nervous. So I think that's what's caused some mixed performance from bank stocks. If you look at earnings growth, though, the sectors that should lead the leaderboard this year would be technology, industrials, and materials. So that's, following those areas, I think would be where you'll get strong performance.
Sarah, do you want to have any exposure to hard assets? I mean, we've been seeing real moves in gold, silver, copper, and other hard assets as this issue of rare earth metals is front and center, and this need for hard assets in this industrial revolution that we're watching.
So hard assets to me are a small piece of people's portfolios and not always the necessary diversification tool. I recognize the story of hard assets doing better. Where we actually think a better hard asset investment is infrastructure. Stronger tailwinds there in terms of building more manufacturing back in the United States. The shift to renewable energy is going to need more infrastructure. And of course, AI demand, you need more power, that's infrastructure. So this is a company in the utility space like NiSource, an Indiana-based utility company with strong growth rates for their customer base, pricing power, and an AI data center play. So that's the hard assets that we prefer for portfolios.
And what about global markets, Sarah? Do you want to be exposed to markets outside of the United States as well?
For diversification reasons, I think it's great, but this has to do with tech versus everything else again. If you believe in tech, that means tech is a dominant U.S. play, and so you believe in the U.S., and we are bullish on technology stocks. I acknowledge, though, that last year, non-U.S. stocks actually performed quite well. So there are some value over there, especially in financials. But we are definitely thinking that the U.S. and technology stocks will continue to lead.
And Sarah, do you want to be avoiding anything? What are you looking at in terms of potential avoiding? And what does a portfolio look like for this year?
Well, within equities, what I would avoid is what we saw a little bit earlier in 2026, which was the safety trade leading consumer staples. That's an area where it's kind of a low growth sector where unless you're very bearish on the markets, they tend not to outperform the other areas. Areas that we like private equity outside of public equities because we think M&A markets and capital markets will pick up this year. We still like private credit, infrastructure, and within fixed income, if you want your non-U.S. exposure, emerging markets debt looks attractive to us now that some of these tariff issues are either well known or moving behind us.
Yeah, we're waiting on the big Supreme Court decision soon on whether or not the president's tariffs are legal to use in an emergency. So we'll wait on that. Is that going to be a big market mover, you think?
I think it will be a short-term mover for the markets, especially if tariffs are rolled back. But I think longer term, tariffs are here to stay. But the good news with tariffs has been the big hit to inflation on the upside that we thought we would see from tariffs really didn't come to fruition in 2025. So I think either way, tariffs are starting to be more priced in. Volatility this year will be caused by geopolitical issues and, of course, some volatility around the new Fed chair announcement.
I mean, I guess there's so much money on the sidelines. You have to believe that eventually it finds a home in equities. When you take a look at this expectation of the tax refund season, I'm seeing expectations of $200 billion in tax refunds. One analyst at Piper Sandler said that he's expecting people to spend 70% of that money. And then, of course, there's some $8 trillion in money market accounts. What do you make of all of that money? And do you believe that ultimately that money from money market accounts, which will see rates go down if interest rates go down, will that money transition into equities and provide a further boost for the stock market?
Well, cash on the sidelines to the tune of trillions of dollars has been a theme for many years now. Part of that was because of high interest rates. You could get 4 or 5% returns on cash, and that's where people chose to park their money to keep liquidity. So that issue, I think, will be ongoing. Now, as we see that come back into the markets, I think it'll go to a variety of places. So I started in the industry 30 years ago. Most people had a traditional portfolio of 60% equities, 40% fixed income. I think for diversification reasons, that portfolio is changing. It's going to be 50% equities, 30% fixed income, and 20% alternatives like private credit, private equity, infrastructure. So as that cash comes in, I think it'll go to a blend of asset classes. It'll be positive for equities, but it's also going to be positive because a lot of individuals and institutions now are looking to add those alternatives to their portfolios.
All right, we will leave it there. Sarah, always great to catch up. Thanks so much.
Great to see you, Maria.
All right, Saira Malik from Nuveen. We'll be right back. Stay with us.